Good afternoon. Welcome back to the August update of Living Off an Income Portfolio. For those of you who joined for the first time, this is a series where I update and track my progress of living off an income portfolio. And then we compare it to a more traditional 4% rule, S&P, and other popular funds to see how these portfolio perform in the scenario where you withdraw more than 4%. So basically, my portfolio is very income focused, and we comparing it with the same withdrawal percentage compared to the VFV portfolio, which is an SP 500, and XEQT and HYLD portfolio. Anyways, the past month has been pretty crazy. Like a market has been really ripping out. I think partially is because I think a lot of uncertainties are gone. So we're seeing good upswing. Our portfolio actually hit an all-time high. Let's get to this page here. I think in all the portfolio, the core holding hit all-time high. The margin also hit all-time high as well. I got some question from last video that so basically this amount is the net of the margin. This is a portfolio total. This is the margin depth amount, and this is the total. So the total amount for the margin account definitely see the highest as well. Not only that, all the fixed income reach all-time high. A lot of the unit here is also a lot of unit here also reach all-time high as well. The Tesla amount we're still holding on to it. We keep selling cover call on this unit. We sell pretty close to the money. So I think we have a 345 cover call opening for this one. I think we're getting about $600 credit here. Um, so some people asked last time that how much have I made from the selling cover call and put total for the year, and if this made a big difference to the portfolio. So I try to keep the personal selling cover call to a fairly minimal because I know myself that I'm gonna get really obsessed and I'm gonna take more risk than I needed. Now that I don't really have a job and I'm living off this portfolio full time, I try not to take too much unnecessary risk. So far for the year, I think we're making about 5K out of the selling cover call on like random ticker. I think so far we did Nvidia, we did some Tesla. Those are the two that I wouldn't mind holding, and they do have a pretty decent volatility, which lead to a decent premium. Anyways, let's move on. So living expense also didn't hit all-time high, but a lot of the unit hit all-time high. So basically, we did a little bit of adjustment in the portfolio. As you can see, we are sold out of JEPQ in the core holding. We actually move all this into the CWT. It pay much less income, but in the core holding, so basically everything in the core holdings is being reinvested for the long-term future. So I decided to sell the JEPQ and then move it to CWT, which has a lot more retained growth compared to JEPQ. JEPQ is paying out a lot of, I think right now it's paying 10%. And overall growth is going to be a lot lower than CWT. CWT paying about 4% right now, but then total growth is a lot higher than JEPQ. Um, when you pay high yield, when you pay frequently, they're always going to create some kind of friction, with option strategy to be able to sustain that kind of payout. You would also have to sell much closer to the money, which also limit your upside. So this portfolio, we want to keep it as growth focused as possible while still, have some yield. So that's why I switched it to CWT. The long-term plan for this account is probably going to be keep accumulating CWT to maybe about 5,500 shares, and the rest is going to be funneling into VFV for a more passive growth long term. Um, Margin account, not much change really. I mean, we just keep selling call on Tesla. We did plan to sell some put on Nvidia if it keep dropping. Today is Monday the 18th. Nvidia dropped a little bit, but we'll see. With the earning coming up and also the Fed meeting in a year, not really Fed meeting, but like a Jackson Hole where Jay Powell and then all the Fed's gonna be talking about the outlook and all these things. So of course there's always usually they tend to not try to give a surprise because they want to make sure that the markets are functioning normally. If you keep dropping bombs all the time, people are gonna anticipate and then they're gonna create a bunch of too much fluctuation. So generally they try to keep it pretty straightforward and not too many surprises. So right now we are assuming that there's gonna be a rate cut next month. I think about 90%, which usually they try to play along with the percent. Okay, so probably gonna keep this as it is for now. I don't think change too much. Just gonna keep selling call until I get called away. Then we might sell put. So depending on how the option would play out. For the fixed income, we are probably gonna hold on to these for a while until basically once the rate are, if the market predict that the rate's gonna go down, I'm assuming these gonna start going up because the fixed incomes are heavily influenced by the rates. As the rate come down, fixed income price goes up, and then yield comes down. So I think these are positioning pretty well right now. Also, because I'm in Canada, these are all Canadian company, and the payout from these preferred shares are also eligible dividends as well, which get taxed in a more favorable rates. Okay, moving on to the living expense portion, we did sell all of USDC altogether and move into JEPQ. Um, I know I said that JEPQ doesn't have as much growth, but overall, I still think that it has more growth than USDC. It also has much less fee. Those are the advantage of JEPQ. It also the holdings are fairly concentrated. Same, like basically the Max 7 is still going to take a big chunk of it, but it's slightly lean more tech for the JEPQ, which I like. It does add a tad more risk to it. And another downside that JEPQ has over USDC is that USDC do have a longer runway, so you have a lot of history to kind of go off of, while JEPQ has a lot less. But I think that long term, these portfolios are kind of more income, so I want something that can last a long time. I think JEPQ with the lower fee and with the decent growth focused portfolio, even though we sell cover call on them, I think long term is going to be okay. We also add a lot of YMAG.NA, which is basically, this is not the yield max one, this is actually the purpose one. I quite like this one because it's focused on the top 8 largest company. I think for the past few years, the big techs are definitely the main growth driver for the whole market. And I foresee that it's going to keep going this way for a while. Okay, so my friend asked me why did I choose YMAC over HHIS. HHIS is definitely the darling of the whole Canadian income landscape right now. One thing I don't like about HHIS is that it is equal weight. So some of you might like that, some of you might not like it. Personally, I don't really care for the equal weight. Also, I like that HHIS is very diversified. It carry more product of the larger cap US company. But another thing I don't like is that I don't want to have exposure into cryptocurrency. Not because I'm against it, it's because of I'd rather maintain those allocation myself. As you can see, HSA has a Coinbase and also MicroStrategy, which is contribute quite a large chunk here. Um, I'm not against this company. I think that they have a good growth prospect. I just rather control that allocation myself, so that's one thing I don't like. Also, if you look at YMAC over here, right, it's a lot more concentrated. It's basically a little bit more of like allocation based on the market allocation. So you can see Nvidia has the big, excuse me. So Nvidia, Microsoft, Apple has the 3 biggest allocation here. I also like that they show you what they sell the option on. You can see that how much is in the money right now, how much is out of the money, and they only sell about half of the whole portfolio cover call on. So overall, I like YMAC a lot better. Another thing is that YMAC has shown that they are a decent manager of cover calls, right? So I think this is the Blossom page that John, only CC user, actually collect data and then showcase of like each cover call funds and how they perform. As you can see, I know. Okay, first of all, this is a very short history, right? So take it with a grain of salt. Things could change. We don't know, and then the data is very limited here. Yada yada. You know the spiel. So since the YMAC came out, it's very new. I hate to quote this data, but this is all we have right now, right? So YMAC definitely outperform everything that is that is a market, overall index base right now. So YMAC HHIS is definitely doing well. YMAC doing slightly better, but what convinced me more, despite the low history, is that you look at this page, it's basically comparing all the single stock ETF provider. Generally, let me look at right here, right? So this YGOG is basically from purpose. In the long run, usually you're gonna underperform the underlying for sure. In this case, they actually outperform Google by a little bit, but overall, usually you're gonna lag behind. But consistently, they tend to beat out the counterpart, which is the Harvest. So they overall tend to do better than Harvest. In some cases, they even do better compared to the underlying, which is quite rare. Some of you might not agree with me, but I do like this better, and I think they have some longer track record that they've proven that they can manage it well. Like they had YTSL been out for a while. They're actually doing quite okay. Like you can see here, it's not that much different between the Tesla and also YTSL. Of course, it's gonna lag behind because with the Tesla being spiking up and down, it's gonna create friction as you sell cover call on. But I feel like despite all that, they actually managed pretty well. But if you compare it to TSLY actually lags behind quite a bit. I know this is very short data, very selective, but overall, I just prefer purpose over harvest in for this particular ETF. Okay, enough rambling on. Let's take a look at before that, we did hit all-time high for the whole portfolio. Despite I think so far we have extracted probably over 50K from the portfolio as a living expense, and then we hit all-time high at all time despite taking out that much. So it's nice to see, but of course, we are planning for a really long 30, 40, 50 years runway. So this is only a short time, but then this is the whole point of this experiment, right? To see how it perform in the long run. Anyways, let's take a look at the VFV counterpart. VFV counterpart is doing well. I don't think it hit all-time high, but it's growing steadily. Right now, VFV is at 984. I think in the last video, HYLD actually doing a little bit better than VFV, if I remember correctly. This is basically S&P 500, a gold standard for an index-based investing. HYLD is actually lagging behind a little bit, I think, because US dollars is kind of stopped dropping like crazy every day. HYLD is, I believe, is hedged. Yes, I think it's hedged. So basically, so that's gonna drag behind a little bit. But overall, I have to say though, HYLD actually hold up a lot better than expected. I actually expect this one to not doing as well as it did. So that's one surprising factor for sure. As you can see, the share count for HYLD go up every time we withdraw because it pay out so much, and we actually don't use that much for a living. So a lot of them are being reinvested back, while VFV's share count slowly go down because every month we have to sell to basically fund the living expense. Okay, next is XEQT, also doing really well. This is also another one that beat expectation because initially when I look at XEQT, I assume that it's gonna underperform VFV by quite a bit just because it's so diversified, right? And then it's also quite heavy in Canada, which historically underperformed the US. But I think this year Canada been doing quite well, so XEQT also doing quite well. And during the Liberation Day, it actually dropped the lowest. So for someone who want a one-stop shop for retirement, XEQT, unarguably one of the best options for sure. So now let's take a look at the side-by-side comparison. So this is the current data that we have. I quit my job, I think, much earlier than November, but I start tracking only in November of last year. As you can see, the portfolio started out the same price and then progress over time. I actually recording on the 11. The reason I do on 11 and not in the beginning of the month because of X date for a lot of the ETF that I hold actually end of the month, and they don't pay until like the 7, 8 of the month. So basically after 11, usually everything's paid out. That's when I recorded the data. So far, as you can see the XEQT here, the really cool thing you can see that during the big dip, XEQT actually right here. XEQT actually holding up quite well while everything else dropped like a rock. XEQT actually hold fairly strong and then rebound quite nicely along with everything else. VFV actually beat out XEQT earlier. However, the moment it dropped, XEQT took over and then now is second place. Our portfolio also dropped quite hard because we also heavy in tech, and tech dropped really hard during that time. So yeah, this is some nice little graph. I love looking at data side by side, and hopefully in the future we can have the whole graph going. That I think it's gonna look really cool. Anyways, okay. If anyone have questions, feel free to leave in a comment. I know not many people watches this. I mainly just made this so my wife can get an update on our portfolio, and also in the future I can look back and see, how I feel at the time, how we went through the whole thing. So this is the total distribution so far that we withdraw since we start recorded. Like I mentioned, we actually quit our job way earlier than this, but I only started recording then. So far since the recorded, we took out 43,000. This is the amount that we took out. Oh yeah, okay, forgot to mention. So as you know, I do trade option on my main portfolio. Nothing crazy, just a small amount. And then I made a trade blunder last month. So basically, the whole thing is I start playing Magic the Gathering with friends, and then basically they had this new set came out, like Final Fantasy set. If you don't play game, you might not know what it is, and it's apparently is the best selling set of all time. So then I went to look at the mother company, which is Hasbro, and then Hasbro has earning coming up, and the expectation for the earning is actually quite low. I think they were expecting like something like 75 cents or something like that. So after looking through a lot of data, talking to Grok, OpenAI like crazy, I come up with the idea where, okay, I think the analyst is definitely underplay the earning. So I bought a very directional call. I don't usually do this. I bought a lot of directional call on Hasbro, expecting them to beat EPS. And this is the amount, right? So it was the right here, Q2. So they did beat EPS by almost 60%. They actually killed the EPS expectation. The guidance was amazing, everything was great, but stock didn't go up. So, as you know, if you buy an option before earning, you are paying a premium on the IV, which is the volatility. And after the earning ended, the IV basically dropped like crazy because the unknown factor is gone. Volatility come down, option price get crushed. I was actually sitting on quite a bit of profit at a time, but I was, oh man, I'm so sure it's gonna work out. They're gonna kill it, and they did kill it, but didn't go up. So basically, I lost the money there. I actually held through, and to be fair, the stock actually continued to gain ground. Um, continued to gain ground ever since then, where you can see that they still keep going up. So in the end, I break even. No, actually, I wouldn't say break even. I basically bought two strike, right? The August 15 strike and November strike. August 15 strike, I break even just from holding on because when the option got crashed, I was like, you know what? It worth like almost nothing. I might as well hold it, and then I hold it all the way until Friday and sold right before closing at about break even. So it was something, but the November strike honestly looks pretty cooked. I bought a 90 strike because I was so overly confident. And this is a lesson that you should take with a grain of salt that take your profit, right? Like going into earning, I was sitting at about $6,000 profit. Like, you know what? It's gonna go up, right? And then it didn't. So you just get blinded by something. I think you just basically the whole concept, the whole idea is to manage your risk properly, and then don't be overly confident. There's always something you don't know. Okay, enough stories. So, but the thing is, with this margin account, there'll be some alpha that you can get. Like basically these fixed income made a lot of gain, and it actually beat S&P by quite a bit. These things are actually paying me 15% per year right now, while still accumulating a nice capital gain just from the right timing of how the rate might play out. But with these kind of risks, sometimes you're gonna end up with a loss as well. So it's part of the game, right? You just gonna have to manage your risk and do your best. Okay, all right. Kind of rambling on a little too much in this video. Now let's go look at the live stuff. We actually killed it in the trying new restaurant. So we had a friend visiting from New York and Calgary. So basically, we used to play games together. back in the day we used to all play MapleStory. So now we still friends ever from 15 years later. So they come to visit. We took them out, meeting up with some other friends, eating out a lot. So end up trying a bunch of new restaurants, which was really nice, but also at the cost of our emergency fund refill goal. So we did spend a lot of extra cash this month to shopping, hanging out, eating out, going out a lot. But it was worth it. Like what's the point of having all this money if you don't actually enjoy with the people you like and your friends and family. So it's okay. We got set back on the refill emergency fund goal a little bit, which is okay. Um, Read books. I haven't touched this month at all. Duolingo slowly going up. Um, Also, Duolingo company has been there was some worry about AI taking over Duolingo company, and then that's why the stock has been dropping quite a bit, even though it spiked up after the earning because the earnings still good. But in the long run, I am a little concerned though because I did try ChatGPT and Grok as a language learning partner. So basically, you prompt them, hey, I want to learn language. Can you be my partner? And surprisingly, it was really nice. Like I was trying to learn Chinese, right? So I would ask them to speak to me in Chinese, talk to them, talk back, correct me, you know, XYZ. Actually, it was really nice. So, if I were to pay for Duolingo, I probably rather pay for an AI agent. I know that, when you're going to say that Duolingo gamify it's more fun, more engaging. I get it. But objectively speaking, I think that, personally speaking, using AI agent to learn language from is probably much more effective for me. Rewatching Combating Height, haven't done any of these. Finishing eBay listing, haven't touched it. Just been so lazy. But yeah, okay, so that's come to the end of this video. I know this one is a bit longer. We did rambling on quite a bit about random stories and stuff like that. But yeah, hope you enjoy. If you have any questions, feel free to let me know. Thank you for the whoever 50, 60 of you who actually watched this video. And yeah, have a good month. Hopefully everyone doing well. Stay healthy, stay safe. See you guys next time.